In this episode, we're going to talk about the 3 phases to invest in income-producing property. Hi, everybody. I'm John Bowens, Director of Education and Investor Success here at Equity Trust. I'm also a real estate investor. I invest in real estate inside and outside of my self-directed retirement accounts. So we're going to talk about these 3 phases and much more in today's program. First, property type research. That's phase number 1. Phase number 2 we're going to talk about is offers and due diligence. And then phase number 3 is asset management or property management. So let's cover those again so you can make sure you take good notes. Number 1 is property type research. Number 2 is offers and due diligence. And then number 3 is asset management or property management. So we're going to break down each one of these phases. If you haven't already, make sure you subscribe to our YouTube channel, hit the little bell icon. That way, when we launch educational videos every single week, we can push those out directly to you. Okay, so let's jump in. Now, first, before phase 1 is discussed, let's talk about why do investors consider investing in real estate? Well, what I have found in doing this for nearly 20 years is investors that are buying real estate are attracted to diversification, the ability to diversify their retirement accounts or non-retirement accounts beyond the traditional stock market investing in real estate. The second are the tax advantages associated with real estate investing. Now, you're going to learn about some of those tax advantages in a retirement account, but there can also be considerable tax advantages in a non-retirement account environment. In fact, you'll find if you learn from some of the best real estate investor CPAs out there in the country that there are some unique ways in which you can take advantage of real estate and be able to benefit yourself from a holistic tax perspective. Of course, we don't recommend any one individual, so we would encourage you to partner up with your own individual CPA or tax planner to discuss what is right for you. All right, also keep in mind long-term appreciation and then, of course, near-term cash flow. So near-term cash flow, long-term appreciation of property, and then the eventual sale of property. Now, we can get into this a little bit more in detail later, but owning real estate outside of an IRA, there's also the capability to defer taxes even further through what is called a 1031 exchange. So in terms of the benefits of owning real estate, you'll find if you talk to real estate investors that there are a number of benefits associated with owning real estate in and outside of a self-directed retirement account. All right, let's jump into phase 1, which is property type research. Now, when we say property type research, we're talking about, are you targeting single family rental properties? Are you targeting properties that you'll need to fix up before you can rent out? Are you targeting properties that are already fixed up, already rented out, sometimes referred to as turnkey real estate investing? Are you looking for duplexes or triplexes? Are you maybe looking to invest in apartment buildings with your self-directed retirement account or non-retirement account funds? Are you looking to beyond holding physical real estate? Maybe it's being a private money lender, lending money secured by real estate to other investors. Are you looking to beyond more of a long-term buy and hold strategy? Are you looking to potentially buy real estate and do more of a short-term rental, aka Airbnb or VRBO type strategy? Now, keep in mind when you are researching property types, your strategy going into the transaction may not be the exit strategy. Here's a good example. I've worked with plenty of real estate investors that bought a single-family rent property. They were renting it out as a long-term rental, and then they recognized that as the market shifted, that would be a good asset for a short-term rental, an Airbnb VRBO type property. And so they furnished the property, and now it's a short-term rental. So just keep in mind that your exit strategy could potentially change as you move and that transaction matures inside or outside of your self-directed retirement account. Okay, now let's talk a little bit more with respect to researching property. How can you develop more education and acumen around this process if you're somebody that's maybe brand new to investing in real estate inside or outside of your self-directed retirement account? Well, there's lots of resources out there. For example, one that comes to mind is a website and a company called biggerpockets.com, and they have lots of forums and education and calculators that you can download and various trainings and education that you can subscribe to. Now, that's just one resource of many that you can tap into. Now, when you're doing research, what's really important is that you're looking at the transaction through two different lenses. All right, so for those of you that are taking notes, you want to make sure you write down these two lenses. The first lens you want to look at every real estate transaction through is the business lens. The business lens. Do the financials make sense? Do the economics make sense? Does the market make sense, right? You want to make sure you're researching this. The second lens is the tax lens, all right? So you got the business lens and you got the tax lens. Does it make business sense? Then you move on to the tax lens. How do I do this and optimize my tax situation? Do I buy this property or this duplex or this apartment building? Do I do this inside of a self-directed traditional IRA? Do I do this in a self-directed Roth IRA? Do I do this in a solo 401k? Do I do this with an HSA? Do I partner my IRA with my non-IRA funds? Do I use my retirement account and buy the property with a non-recourse loan? You want to be thinking about the tax optimization of the overall strategy. Or maybe it's not using a self-directed retirement account. Maybe it's using your non-IRA funds. Now, there are tax advantages with using non-IRA funds as well. You have depreciation. In some instances, you might do a cost segregation study and have accelerated depreciation. You have the depreciation and your expenses that will ultimately offset your income. Maybe you have passive losses that will offset future gains or current year gains. There's all sorts of ways in which you can utilize the tax advantages inside and outside of a self-directed retirement account. All right, so you want to be thinking about that. Now, as far as running the numbers on a property, the basics of this are what is the gross rent that you can command? So on a monthly basis, what is the gross rent that you can command? And there's all sorts of tools online that you can subscribe to now where you can develop an understanding of what that gross rent would be. Are you on the high side? Are you on the low side? Or are you just in the middle? What types of tenants are you looking for, right? You want to be thinking about that. So all sorts of tools that you can get your gross rent per month. Then what are your operating expenses? Keep in mind, taxes, right? Insurance, interest if you have a loan, right? Your mortgage payment, although not in the operating expense column, but you want to make sure you're thinking about this from a cash flow perspective. So you want to look at your operating expenses. That would also include repairs. Outside of that, you also want to factor in any improvements you need to make. Are you buying this property turnkey where all of that has been done for you? Or are you buying a property that is going to have some maintenance, repairs, maybe even some improvements? You need to be thinking about that. You want to budget for that when you go into the transaction, especially if you're using a self-directed retirement account. If you only have so much money in that retirement account, you want to make sure that you have enough cash in that IRA to finance those necessary repairs and improvements. From there, you want to factor in, of course, property management if you're going to hire a property manager. Lawn care. In my experience in talking to thousands upon thousands of investors, I can't tell you how many people they try to run their numbers on a scratch piece of paper, or they try to do it in their head. You're going to find that there's all sorts of calculators out there. I mentioned biggerpockets.com before. You can download calculators where you plug in all the necessary information. That way you don't miss something important like lawn care or repairs or property management. You need to be factoring in all of these pieces and parts so that you can determine, is the offer you're going to make, is that going to be prudent for you? Are you going to be able to generate appreciation on that property? You want to look at the market, population trends, different companies that may be moving in or out of that community or neighborhood. You want to be thinking about that so that you can calculate your overall what's called internal rate of return, all right? And then you also want to look at what is your cash on cash return, right? So every dollar that you put into that deal, that would include all of your expenses in repairs, improvements, right? Every dollar you put into that transaction, how many dollars are you getting back? Or how many cents are you getting back per dollar? That's important to understand in the near term and the long term. Keep in mind, if you want to sell that property and you have a tenant in that property, are you going to be able to do that? Is a buyer going to want to buy that property? Is it going to be desirable? I'll also mention age of property, right? If you're buying houses that were built in the 1920s, 1930s, the maintenance and repairs are going to be different on a house like that compared to maybe one of these build for rent type properties where the house was recently built and you're buying it with a tenant in it and now you have cash flow. Now, keep in mind, you're oftentimes paying for that, right? So there's going to be a premium in most cases that you're paying to have that higher quality property in comparison to maybe where you're buying a property where you're going to have to put some work into that property. Okay, now let's move on to number 2, which is offers and due diligence. So it's important to understand, especially if you're a newer investor, that you may make an offer and that offer is not accepted. Or you may make an offer and you have multiple other investors or individuals that are making offers and their offer is higher than yours. And so as a result, your offer is not accepted. Keep in mind that you did the research. That's why we talked about research, due diligence, running your numbers, building a pro forma, doing an analysis. What is your maximum allowable offer? So you're going to hear in the real estate world, there's this concept, MAO, M-A-O. That stands for maximum allowable offer. So you run your numbers and you know this is how high I want to go. And if somebody else is bidding higher, most likely they did not run their numbers. Okay, so you want to be careful and not unfortunately fall in love with a transaction that is not a good business decision. Remember, you look at everything through the business lens and then you look at it through the tax optimization lens. So you might have to make multiple offers to finally find the opportunity that makes sense for you. All right, due diligence. We've talked a little bit about due diligence already. We've already done some due diligence in phase 1, right? When we make our offer, we are now, yes, in the due diligence period, and there are opportunities as long as the contracts are written properly. There are opportunities to be able to back out of the transaction. Now, you got to be careful with that. Make sure you talk to an attorney or your real estate agent about those mechanisms. But in the due diligence period, one of the most important parts of it, once you have your offer accepted, is an inspection, right? So you want to make sure that you have a good inspector come to the property, and if you have the ability yourself, go to the property when the inspector is doing the inspection. Now, I'll tell you from a personal perspective, I had an opportunity once. I was selling a property, not as a real estate agent, but I owned a property and I was selling it. And the inspector came and I just asked him, I said, do you mind if I, kind of follow you around and, just so I know what might be damaged and what I might need to address? And he was perfectly fine with that. And so he allowed me to essentially shadow him through the entire inspection. And this inspector was, out of all the inspectors I've met, he was one of the most thorough inspectors that I've ever met. Now, remember, I was the seller, so for good or for bad, in retrospect, I'll say he pointed out some things that were important that we're able to take care of in advance. And secondarily, I learned a ton from him. And so that's one just sort of call it tip that you can think about. I'm not saying that you have to do that, but it's a tip that you can, take it or leave it. So an inspection is really important. Now, you can go online and find an inspector. You can ask around your local community. Some folks become part of what is referred to as a real estate investor association or real estate meetup groups. So just do some research online and type in real estate meetup group or real estate investor association. These entities, these organizations are all over the country. And these are organizations that you can go to. And oftentimes there's people that have used inspectors. There's people that are active real estate investors. So ask around and get a good referral. Make sure you get a good referral. All right, so we spent a good amount of time there because obviously an inspection is really, really important. Now, as things come up on an inspection, which they always do, you need to understand how to address those types of items. Some of those items are going to be very minor, like a switch doesn't work or a ceiling fan has a broken bulb or something of that nature, right? Those are simple repairs that can be done. Now, in some instances, you might be able to, in the due diligence period, work with your real estate agent and actually negotiate some concessions, all right? Where they'll be okay, the seller will agree to lowering, if you will, the amount of the purchase because of the amount of money you're going to have to put into that particular property. Another thing in the due diligence is understanding point on sale inspection. So depending on the city you're in, the ordinance Maybe where there is a point on sale inspection. And if there are point on sale inspection repairs that are necessary, you as the buyer may need to, in your negotiation, assume those point on sale inspection repairs. And then you have a certain period of time after closing to complete those repairs, have another inspection done, and then that is signed off on by the inspector, by that particular municipality. So just keep in mind you have your inspection, and then you could have the point on sale repairs that you have to address. The seller might take care of those, or that might be something you negotiate with the seller and you assume those repairs. And if you're doing that, you could potentially negotiate a lower price, right? Okay, so those are some of the items in due diligence. And of course, when you do an inspection and there are, call it larger ticket items, foundation issues, roofing issues, water issues, the heavy big ticket items, those can be a massive concern. Those could be an absolute deal breaker. What you could look at is having that inspection sent to contractors and get opinions from contractors on what would it cost to do that work, or what is the severity of that issue. For example, something that looks like could be a major foundation issue might actually not be a major foundation issue. Or something that you look at on the inspection looks like a very minor foundation issue, but then you buy the property and you have a contractor come to the property and you recognize that, wow, I just made a massive mistake. And do you think that's happened to real estate folks? Of course it's happened. So get a good inspection, have a conversation with that inspector if you can. They might even be able to refer you to some contractors, and then talk to some contractors about what would the work be required in order to complete that. All right, last but not least, number 3 is asset management and property management. So let's assume everything works out. You buy the property. Now you got to manage the property. Now, who's going to manage the property? Are you going to manage the property? Are you going to find the tenants? Are you going to screen the tenants? Are you going to do the background checks? Are you going to draft a lease agreement or get a lease agreement, have the tenant sign it? Are you going to handle the day-to-day phone calls from the tenant? Keep in mind that an in-state property, if you will, or property in your own neighborhood versus a property out of state is going to be different. And it may not be possible for you to manage the property out of state. You might need to hire a property manager. So you want to look at the pros and cons between hiring a property manager and trying to do the property management yourself. With a self-directed IRA, there is an important rule of thumb to notate. With a self-directed IRA, we like to say that you have the ability to do the desk work to a certain extent, but you cannot do the physical sweat equity. Okay, so putting the hammer to the nail can be a major issue with an IRA-owned property. Remember, the IRA has incredible tax advantages, and you have to respect that. Non-IRA, maybe you are swinging the hammer to the nail, but you got to analyze, what is my time worth? Is my time worth going out there and swinging the hammer to the nail, or am I better off paying someone to do that? So you either hire a property manager or you try to manage the property on your own. In terms of managing the property on your own, there's certainly lots of education. I mentioned biggerpockets.com earlier. And then as far as online software to utilize to collect payments and to manage tenants, there are a variety of online platforms that will enable you to have tools and resources to manage properties that your IRA or non-IRA owns. All right, so from the top again, property type research is phase number 1. Number 2 is offers and due diligence. And number 3 is asset management or property management. And just keep in mind that your exit strategy may change over the course of these transactions. I hope you got a lot out of today's program. Lots of detail, a lot of content. Remember some of those resources that I mentioned, biggerpockets.com, for example. Obviously, there's others as well. Download a good calculator so you can do all of your due diligence and your research on the properties that you're looking to invest in. Work with local professionals, work with an inspector, work with good contractors that are licensed and bonded, insured. Make sure that you're doing all of your thorough due diligence. And again, one last time, look at every transaction through the business lens and then look at it through the tax optimization lens, whether that's using a self-directed IRA or not using a self-directed IRA. Again, I'm John Bowens, Director of Education and Investor Success here at Equity Trust. Until the next one, Keep leveraging compounding interest in the absence of taxation.